C&J Capital here, aka it's cheaper to get a hat than a haircut. Today we're talking about shorting stocks and everything you need to know before you short a stock. So if you don't know what shorting a stock is, shorting is the opposite of going long. If you buy a stock, let's an example, you buy Apple at 200 bucks, anything above $200 you make money on. As the value of those shares go up in price, you make money. If you went long at $200, 201, 202, you make money as it rises above the buy-in price. Shorting, it's the opposite. If you short Apple at 200, when it goes below 200, 199, 198, you make money on that. And you lose money if it goes above where you shorted at. The exact opposite of going long. So how this works is when you short a stock, you're borrowing the lender, which is your brokerage account, could be TD, Fidelity, Interactive Brokers. They have a certain number of shares in their own portfolio, different companies, and they lend you those shares, and you sell short the company you want to short. You sell short, you make money as it goes down. Ideally, you short at a price, and it goes down, the price goes down, and then you buy the cover, meaning you buy back those own shares that you shorted, and then the lender gets the shares back, and you get the profit of the difference between where you shorted and where you bought back in. So a few things to keep in mind before you short a stock. Number one, you need a margin account. A margin account is being able to borrow your broker's money. When you're able to borrow your broker's money, they allow faster cash settlements. They allow you to borrow more money so you can make larger purchases and in turn get larger profits.
Go ahead.
I can't.
She just made a smoothie right now.
Whatever brokerage account you have, if they allow margin trading, you need to be approved first. Maybe not in Robinhood, but in like more legit brokerage accounts. It's been a while since I signed up for margin. Asked, work experience, income level, experience in the markets, what you plan on trading. I pretty much said I was an expert in everything, and they approved me for margin. That's your first step in shorting, is be approved for margin. I don't think you need to be approved for Robinhood margin. I think they give it to you, if you just have a pulse. Fidelity, TD Ameritrade, they actually take their time and look into if you should be able to get margin or not. So number two, let's say you were approved for margin and you're ready to start shorting a stock. You go on and you look at the ticker that you want to short, and you find that there's no shares available to short. There's nothing you could do about that. A lot of brokerage accounts, they don't hold these risky stocks in their own portfolio, so they're not available for you to short. Certain brokerages that pretty much specialize in kind of like the penny stock traders, and they focus strictly on getting those kind of shares. If you want to start shorting like penny stocks, you're going to have to look into brokers that specialize in that. There have been times where on Fidelity I wasn't able to find like a stock that I wanted to short, but the ones I was looking at were kind of like low price stocks who aren't really that liquid, so that might be part of the reason. Number three, a big one and a reason why a lot of people try not to short is because you can lose more money than you put in. The reason being is because there's no ceiling on how high a stock can go. If you're shorting a stock, that stock can go up 100% easy. It can go up 500%, 1,000%. There's no ceiling. If you're going long on a stock, the stock it can drop to zero, but that's as far as it can go. When you go long on something, if you bought 100 shares at $100, those 100 shares can go to zero. It's unlikely. It doesn't often happen at all. It's capped because there is a floor. It can't go below zero. But with shorting, because you lose money as it goes up, there is no cap. It can go as high as it wants to. Your brokerage account has some responsibility in that manner too. If you have a margin account, you're borrowing their money, so they don't want to see you blow up your account to where you have a negative in your balance. Goes into number four, a margin call. A margin call is when a broker contacts you, email, at the very worst, they may call you, and they'll either tell you to either liquidate all your positions, meaning sell everything, cover everything. They'll tell you to deposit more money. Since you're working in their brokerage account and you're using their money during margin, they could liquidate all your positions for you, and that's one of the worst. That's not a fun time. If you're in a margin call and it's a serious margin call, that's gonna ruin your day for sure. Next would be the fees. So there's a fee, an annual fee on margin. You know, you could call in and try to negotiate a better price for your margin fees, but there are usually fees for when you have a margin account. It's usually not like crazy high, but you know, it's still a fee that you have to pay. When you short a stock, you're paying a short seller's fee, and that's the cost to borrow, and that's another fee on top of, you know, your margin, extra fees that you're gonna have to deal with. All right, the next one is the short squeeze. A short squeeze is when a lot of people are shorting stock, right? Pushing the stock down, and then the other side, the buyers, want to buy at this lower price. And what happens when a lot of people come in to buy, the stock goes up. If a trade is going against you, you want to cut it. But with shorting, you're literally buying the shares. So that's another set of buyers that are coming in. Short squeeze, a lot of sellers pushing the stock down, a lot of buyers come in, start buying, pushes the price up. Short sellers start to buy in to cover, shoots it up further. You could lose a lot of money. Dividends. If you're shorting a stock that's paying dividends, you have to pay those dividends to your lender. So the brokerage account that lets you borrow the shares to short, if you're shorting a dividend paying stock, you have to pay those dividends. The amount that they would receive for the dividends is what you have to pay them. So that's, you know. Next one is taxes. You're long a stock, right? You buy a stock January 1st, 2018. You sell it January 1st, 2019. It's called long-term capital gains. And if you make money, you only pay a smaller amount, which is usually 15% taxes on those capital gains. If you hold for less than a year going long, it's usually about 35%. With short selling, you could be shorting for a year and you're still paying the same you would if you held it short term. So it's higher taxes when you short a stock. So next is early sale. Early sale is when your broker wants their shares back. So you have to make up for those shares. Regardless if you're in a profit, you're at a loss, you have to give back those shares, meaning you have to buy back the amount of shares you shorted and return them to your broker. Get down simple what I just went over. You need a margin account. You need to be approved for margin. Not every broker has every stock you want to short. You can lose more money than you put in. The fees are higher, margin fees, borrowing cost fees, taxes are higher. Short squeeze could wipe a lot of portfolios out. If you get close to wiped out, next thing is a margin call. You pay the dividends if it's a dividend paying stock.